Hi. Yeah, hi. Good evening to all the participants, and thank you for joining in. For this CCP webinar. Um, we are hosting this webinar at an opportune time. The second quarter earnings, are nearly done. Just a couple of more days, but majority of the results are already out. Um, and It's an opportune time because of several developments that have happened over the last several months. In particular, in terms of the agenda for this webinar, we shall first provide an update on portfolio's progression, and particularly emphasize on the period from beginning April, the current financial year, leading up to the second quarter earning season. It's been interesting several months, and Rakshat will discuss several different aspects around the portfolio's performance, and some of the macro data points that have emerged recently. And Then we'll move on to the theme for today's webinar. The newsletter came out a couple of days ago, and Rakshat will talk about certain aspect which is a sort of a common thread across our portfolio holdings. And then we'll move on to a Q&A session. So let's get on with it, and Rakshat, over to you.
Thank you, Arjun. Good afternoon, everyone. Good evening. Quite an interesting day, quite interesting times to be doing this webinar. So let me kick off first with the performance as on 31st October, last month end, for CCP. This is the performance chart. It's been a decent performance in the more recent months, so 6 months, 12 months, and since inception as well, the longest time period you see on the chart on the extreme right. There's been a good absolute and healthy relative returns, but in the interim period, particularly the last 3 years, there's been weak absolute and relative performance, and also the month of October was pretty weak in an absolute manner, both for the market as well as for CCP. Delving a bit deeper into it, so this is the 3-phase chart that you might have seen from our previous presentations. Over the last 6 years of journey of CCP, the first and the third phases, which is the first 3 years and the last 2 years, have had healthy absolute and relative performance, the blue bars here that you see on the chart. But it's the interim 1-year period of calendar year 2022 largely, which was quite painful. I would say the most painful part of the last 6 years journey at Marcellus. That's given us lots of learnings. That's largely behind us. The recovery is underway. We've made changes to lots of ways in which the portfolio construction is carried out here, and I'll be discussing about some of those as we go through this webinar. This is the usual slide on fundamentals for the CCP portfolio. The last 2 columns talk about the EPS growth year on year for the first 2 quarters of FY25. To begin with, there's been 0 to negative profit growth for the broader market. If you look at the bubble on the extreme right here, which is talking about how the Nifty, the BSE 500 or the broader stock market has performed. Till 31st October, the parts of Nifty 50 that reported results showed a -1% profit growth, and possibly the aggregate number for the entire index will be further down from that level once the entire Nifty 50 set is sort of aggregated after a few days. These results at an index level, they suggest that broader economy is not in its best shape, quite clearly. We see 2 polar opposite trends in this broader economic backdrop. On the one hand, corporate balance sheets are reasonably healthy. They are flush with cash. Banking sector balance sheets are pretty healthy. But on the other hand, household balance sheets seem to be under some stress to the extent that some of the FMCG companies are also reporting low single digit volume growth at best. Some of them have even reported.
If I can just interject you here, sorry for that. A lot of clients are pointing out that they're not able to view the slides on the screen, and
you can view it, Arjun?
I can view it, yes. Naren,
should I share it again? Okay, can you view it now, Arjun?
Yes. So some of the clients who've pointed out, this aspect, can you just
maybe it's the Zoom app that they're using and the window in the Zoom app.
They can view it now, yeah. So actually, you can continue.
All right. So I was talking about the fundamentals of the CCP portfolio vis-a-vis the broader market. So the bubble on the right is what I was referring to for the broader market to begin with, where there has been no profit growth in FY25 so far, whether it be for the first quarter or the second quarter. First quarter was a marginal 1% growth. Second quarter so far has been a profit decline for Nifty 50. As I said, there are two polar opposite parts to it. One, healthy corporate balance sheets, but perhaps weak consumption trends, because many of the FMCGs have also reported a decline in volume growth for small ticket staples. So that's where a large part of the indication of weakness in the broader economy is. In this backdrop, CCP companies have delivered 23% weighted average profit growth in the first quarter and 8% weighted average profit growth. The bottom row, the red shaded bottom row, extreme right, in the second quarter. So 23 and 8 on average, 15% profit growth for the first half of FY25. That's obviously weaker than what we would like it to be in a normal environment. In a normal environment, we expect the CCP companies to deliver at least 20% profit growth, if not higher. That is what they have delivered year after year over the last 6, 7, 8 years of managing this portfolio. But the 15% for the first half, it's weaker than the long-term expectation, but it's significantly stronger than what Nifty 50 has delivered. It's a 15% outperformance of EPS growth compared to Nifty. And why is this important? This is important, one, because the philosophy is meant to deliver its performance through long holding periods of stocks and hence largely through fundamental growth. If you've got long holding periods, the contribution of fundamental growth to the performance of the stock and hence to the portfolio becomes far greater than otherwise if you had a high churn portfolio and you were trying to time only price to earnings multiples expansion and the right timing of entries and exits, etc. So having healthy fundamentals, healthier compared to the broader market, is important. It has been delivered year after year. If you look at the last 5 years or 7 years of EPS CAGR of our portfolio constituents at any point of time, not just today's constituents, but even constituents that existed a year ago or 3 years ago, the long-term EPS compounding has been a good 10 percentage points healthier than that of Nifty 50. So that outperformance continues. Now, just preempting a pretty valid question from many of you, which should be that how do we see opportunities in this backdrop for our portfolios construction going forward? So I'll break it into 3 parts, the opportunity set. The first part is thanks to the width of the sectoral exposure that we've got now in the quality universe of CCP, and that width has particularly been expanded in the last 12 to 18 months. It gives us many options to pick up high quality businesses in sectors which are not significantly exposed to the broader slowdown that we are witnessing in the larger economy. So, for instance, healthcare orientation through hospitals, pharma, private capex around manufacturing, exports, IT services, particularly those IT services companies that are beneficiaries of the evolving nature of demand in IT services. I mean, these are the areas where there are opportunities to orient the portfolio within the quality universe and keep your head above water in terms of outperforming EPS growth versus the broader market. The second area is several of our portfolio companies that we want to pick up are implementing business initiatives that expand the canvas, that expand the target market. They add new profit growth drivers to their business, and hence create drivers of resilience in their earnings. So, for instance, what a Tube is doing with business initiatives beyond their core, what Narayana is doing, what Trent is doing. So that's the second bucket, companies that are taking newer initiatives to drive earnings growth beyond the core. And finally, several of our portfolio companies are sitting with large piles of surplus cash on the balance sheet, waiting to be deployed towards organic or inorganic opportunities when an attractive enough opportunity arises. And particularly in an environment like this, where there's a weakness in the external environment, the ability to use the cash to power up your overall business growth prospects going forward, in a way, as they term it, never let a crisis go waste. So if the broader macro is undergoing any sort of weakness or turbulence, then the likes of, let's say a CMS, an Escorts, a Dr. Lal Path Labs, and Alchem, these are companies sitting with bucket loads of surplus cash on their balance sheet, which can be deployed towards opportunities which become far more attractive in a weaker environment to capitalize on. Right. So particularly the second and the third bucket that I talked about, which is companies that are going beyond their core to capture new growth initiatives. We call these enterprising compounders. We call these optionalities oriented businesses. And this is where we've reoriented the portfolio over the last 12 months. And this is where we expect to generate significantly superior earnings and significantly superior, as a result, outcomes for the portfolio relative to the broader market. Now, coming to the theme of the newsletter, which Arjun mentioned in the beginning, that actually links into this piece of enterprising compounders and companies that are going beyond their core to widen their turf, widen their canvas, and grab new opportunities. So to begin with, let me explain these three charts which define the theme that we've highlighted in our recent newsletter, which is that there's been a clear disconnect emerging between companies which grow fixed assets at a fast pace and those that grow profits at a fast pace. This is a very interesting disconnect, where first of all, in the chart on the extreme left, you can see the highest profit generators, which is the top decile of companies by profits, are not the ones that are able to grow their profits at the fastest pace, right? So let me go a little slow here. So if you rank companies in descending order of their profit size, the top decile of companies by profit size are not the companies that are growing their profits at the fastest pace, right? So that's why you see the black line of decile 2 going above the blue line of decile 1 in the chart on the left, right? So that's the first part. How does that then link into fixed asset generation and comparisons there? So the middle chart is showing that companies which have grown profits at the fastest rate right, which is the second decile, are not the ones who have grown their fixed assets at the fastest rate, right? So fastest profit growing businesses are not the fastest fixed assets growing businesses. And this is CMI data across 40,000 companies, listed, unlisted, all put together. And then if you link it to only the listed universe, it's the chart on the right, where for BSE 500 universe, the chart on the right, the third chart that you see, it's only for the BSE 500 universe where profit growth for companies has far exceeded the growth in their fixed assets. Now that's been going on for 8-9 years, but particularly stark for the last 4-5 years, where profit growth has significantly exceeded the growth in their fixed assets. Now, some of you might want to ask, is this a temporary phenomenon? Is this because India did a lot of capex 15 years ago, capacity utilization levels were low, no fixed asset addition happened, private capex was weak, and hence profit growth has been far stronger than fixed asset growth for the companies which have grown profits at the fastest pace? Is that the reason? Actually, that would have been a smaller contributor till a few years ago when there was absolutely no capex happening in this country. But it is a phenomenon that has existed in the developed world for the best part of last 40 years, 4 decades. And we actually picked up the title of the newsletter also from a book written on this phenomenon. So Jonathan Haskell and Stian Westlake had published a book in 2017 called Capitalism Without Capital. And the central theme of the book was that corporate investments in the developed economies, this is developed, not necessarily only the economy that we are living in the developed economies, over the last 4 decades, corporate investments have become far more intangible asset oriented than tangible assets oriented. So rather than factories, machines, intangible assets are being invested in by the best quality companies in the developed world over the last 4 decades. That is exactly what we see happening in India as well. This we don't think is temporary. This is something which is reflective of higher asset turns over a period of time through more intangibles driving the top lines of these businesses. This is also because of intangible moats, competitive advantages being created, which drive the business forward. And rather than putting up only factories and fixed assets in plants and machinery, businesses in India, the fastest profit growers in India, are able to grow their profits at a much faster rate than their fixed asset growth, right? Now, how does this get reflected in the kind of businesses that we have invested in, right? So this slide, you've got all the 19 charts of portfolio constituents of CCP as of 31st of October. If you see across the 19 charts, in each of these charts, the solid line, which is representing profit growth, has been running ahead of the dotted line, which is representing fixed asset growth, right? Barring the bottom 4 charts, which are more for the lenders, the financial services companies, where obviously profit line and fixed asset line are more or less growing in the same fashion. These are different types of businesses, but excluding the bottom row, if you look at the rest of the pack, barring a couple of exceptions, let's say a Dr. Lal or a Pidilite, here, everywhere else you see a wide jaw opening up, right? And in fact, that jaw is jaw opening up is part of a flywheel of higher cash generation, which then gets redeployed through incremental business initiatives, which is actually what is reflected in the Dr. Lal and Pidilite chart. And as a result, as that cycle repeats, you see the jaw open up for the best quality businesses. The profits grow faster than fixed assets. and then cash gets generated, and that cash gets redeployed to drive further growth in earnings, so on and so forth, right? These companies are in effect investing in more intangibles, and they are sweating their tangible assets harder and harder as they drive their profit growth. Now, what are the factors which are sort of driving the profit growth faster? If you were to break them down, particularly the intangible asset creation, if you were to break it down, so there are three broad categories of factors that are causing this phenomenon, right? And this is again not just for India. This is for the developed world in the last 4 decades as well. The first piece is intangible assets offer massive scalability advantages, as in you can scale up the benefits of an intangible asset to any length once you've developed that competitive edge, right? And we've used, let's say, Narayana as an example here. For those of you who might be aware, Narayana has managed to extract higher asset turns. Assets for them are doctor's time, as well as operation theaters and all the machinery around it. Higher asset turns over a period of time, and passed on those benefits to customers through lower pricing, right? So if you look at average revenue per patient or average revenue per operating bed, Narayana's outcomes are 30 to 40% lower compared to all the large listed players, particularly North India oriented hospital players such as, say, a Max, a Fortis, a Medanta. Narayana is significantly lower on average revenue per patient, average revenue per operating bed, by sweating its assets harder and harder. Now, how are they able to do it? It's a massive intangible around tech architecture that they have created, which they embarked upon as a journey 8 years ago, 7 8 years ago, and they've custom built tech to capture medical records, paramedics processes, hospital workflow, internal chats between doctors, paramedics, at times even patients and their families, so on and so forth. What that does is it creates a process orientation that can be scaled up even via their integrated clinics, let's say, going forward, right? So Apollo is a pioneer in launching clinics, diagnostics, pharmacies, etc. But the difference between Apollo's clinics and Narayana's clinics is Narayana's clinics are joined at the hip via the tech architecture, which becomes the intangible asset through which the clinic becomes a funnel for new patient flow that can then straddle across all sorts of offerings of quaternary care, tertiary care, diagnostics, pharmacy, so on and so forth for Narayana, right? So that's one example of how scale leads to, and you can see it on Narayana's chart here, the third chart in the top row, how scale of intangible asset leads to, without much of fixed asset growth, significant profit growth. Obviously, this is in simple terms, you can call it efficiencies, but those efficiencies are not because you're not reinvesting into any asset, but they are there because you are reinvesting into intangible assets far more than tangible. The second types of benefits are spillover effects, where you create an intangible for one type of business and you leverage it in multiple businesses, right? And the best example here is Trent, where they created an architecture of procurement, making the buyers as the power center rather than the designers or the sourcing teams as the power center, to offer relevant products at the shop floors for customers, thereby driving very high asset turns, for very high inventory turns particularly. The biggest asset for a retailer, apparel retailer, would be inventory lying in the warehouse and in the stores. And Westside is where Trent started this intangible architecture's benefit, and it is being leveraged beyond Westside into Zudio, where in fact inventory turns are 10 times compared to industry standards of 2, 3, or 4 times at most. No other apparel retailer, listed or unlisted, that we are aware of, delivers more than 2 to 4 times inventory turns. And here, Zudio is delivering 10x, Westside is delivering 6x. And the outcome as a result is more relevant products, less dead stock, higher full price sales, and hence higher returns on capital employed for the format. And no wonder when you look back at the charts again here, Trent, as Zudio has ramped up, as Westside has ramped up. Remember, these are not by definition asset light models, but the way the intangible has been ramped up here, you can see in Trent's case, the chart on the top left, second chart in the top row, the solid line is pulling away from the dotted line, right? So that's the second type where you create one asset, and now Star Bazaar is also with its private label offering, benefiting from the similar mindset. Obviously, not apparel as much as Zudio is benefiting from Westside, but Star is also on similar lines. And the third piece of using intangible assets to scale up your profit growth far faster than fixed assets are the synergies around multiple intangibles created, joined together to give a better outcome than any individual intangible in standalone piecemeal basis would have been able to deliver, right? And an example here from the portfolio is, let's say, CMS. So if you look at how CMS has built its business, it was largely all cash management at the ATMs, which thereafter got leveraged with other intangible businesses around technology, around route efficiencies, around software. So when I say technology is the more AIoT type of stuff. When I say software, is the software that helps you operate fixed assets of banks in a better way. They've created 4 or 5 different engines of intangible moats, and then they've joined them together. So it's not just the ability to manage compliance and logistics. It's not just the ability to derive incremental operating efficiencies, and it's not just software and AIoT. Different businesses created, offered to the same customer, and hence locking in the customer for a far longer period of time, generating higher returns on capital employed over a period of time in an industry where intuitively someone would argue cash is not a high growth industry, if at all. It is not probably even a growth industry. The moment ATM penetration goes towards saturation levels, why should a business like this see any growth whatsoever? But having said that, not only have they managed to grow in the ATM business by sort of increasing their penetration, but that's a smaller part of the growth. The greater part of the growth is joining up of several different businesses together to offer to the same customer, and hence a very healthy historical growth profile that they have built here. So that's in effect what we are targeting via CCP in terms of this phenomenon. Now, how does this throw up a certain risk as well, right? I mean, remember, it's not so obvious that any company which grows profits at a faster rate than fixed asset is going to pull away consistent compounding of free cash flows in the long run. The biggest risk here is that if fixed asset growth is lower than profit growth because of under investment or weaker reinvestment rates, then obviously the profit growth will stall. It will stagnate. It will stop after a few years, because there's only a limit to which you can keep deriving operating efficiencies only on the let's say simple plain vanilla margin expansion type of stuff, and hence derive faster profit growth compared to fixed asset growth. There's a limit to which you can derive efficiencies around working capital compression, and hence faster cash flow growth compared to fixed asset growth. There are limits to all of these areas, and those limits exist if a business reduces its reinvestment rate, right? If the cash being generated is not being pumped back And that's why the fixed assets are growing at a slower rate than profits. Then they could also be a sign of concern here. And the table on the left for the CCP portfolio shows how the high reinvestment rate of our current CCP companies has been avoiding that risk. And in effect, you can even see why we exited from some of the companies from our portfolio, because a couple of consumer businesses in our portfolio that existed till 6 months, 12 months ago, over the last couple of years, those companies had stopped reinvesting their capital altogether, and driving profit growth from avenues which won't last for too long in a very healthy way if there isn't any reinvestment happening. And that then brings to the fore the importance of the flywheel that you've got on this slide on the right hand side, where the higher profit growth compared to fixed asset should certainly lead to two types of opportunities. One, the spillover effects, the scale effects, the intangible leverage effects that you need to create. The way I gave you the examples of CMS, of Narayana, of Trent. That is one area of opportunity where intangibles have to be used to their full advantage to grow new business initiatives. And the second is, obviously there will be cash accumulation on some of such balance sheets where profit growth is faster than fixed asset growth. And that cash being accumulated has to be pumped back into the business to capture new opportunities of growth going forward, in order to sustain the consistency of fundamentals compounding. So that's where we are quite comfortable with the reinvestment rates of our portfolio companies. In fact, the likes of, say, a Tube, Narayana, Trent, they are already exploiting many new areas of growth. So Tube with a lot through CG Power as well as through its own clean mobility and CDMO and surgicals initiatives. Narayana with its integrated businesses, integrated clinics, as I explained, and Trent has got several other formats in incubation. These are some of our larger allocations in the portfolio where the engine, the flywheel, is already on to grow beyond the core, which is becoming the reason for earnings growth resilience as well. So the 46% PAT growth for Trent, the healthy 15-16% earnings growth for India business of Narayana this quarter, the way Tube is growing its business. I think these are going to create resilience against a weak macro, which we are trying to benefit from via the larger allocations in the portfolio. And finally, as I mentioned, there are several other relatively smaller allocations where we are watching how large cash piles available to a CMS, to an Escorts, to a Dr. Lal, to an Alchem are being planned to get utilized towards either organic or inorganic avenues of growth going forward. So overall, to conclude, CCP is loaded with capitalism without capital, and hence it's playing on the global theme which has successfully prevailed for the last 4 decades in the developed world. And there are a wide range of optionalities that we're trying to benefit from through investments in intangibles and reinvestment of accelerated cash generation by these companies in the current environment. So I'll stop here and give it back to Arjun to pass on the questions that some of you might have.
Right. So thanks, Akshat, for that. And thank you, all the participants who've already put in their questions. If you'd like to ask a question, kindly use the Q&A box, and we'll try and answer as many of them as possible. So I'll begin with the topic at hand. Basically, there are a couple of questions on the thematic piece. Shrikant Jaikumar has asked a couple of questions. So first one is, can you talk about capex and profit growth in terms of CCP portfolio? I think you already showed those charts, so that's answered. Second question he's asking is, majority of the CCP companies produce real assets, right, such as paints, pipes, trucks, APIs. How does the theory of intangible assets, capitalism without capital, play into these companies, given they require factories to produce the said real assets? I think you've partly answered that question, but if you want to add something to it.
Yes. So, I mean, it's not that capitalism without capital means only the tech sector where the offering is a service or an intangible. And capitalism without capital is not about companies which offer tangible assets as their products to the customers. That's not the case. What these charts, what even the extreme right chart, sorry, no, the left two charts are pointing towards for the broader Indian corporate world, or what has been pointed out in the book that I referred to about the developed world. It's that there are companies that drive growth by setting up more factories, by setting up more depots, more furnitures, fixtures oriented investments, by acquiring asset heavy businesses where the asset itself was the driver for IP, for growth, for competitive advantage. Those kinds of companies used to certainly prevail as the best companies about 100 years ago in the developed world. Over the last 3-4 decades, the nature of competitive advantage for even a Costco, let's say, right? Costco is a player in the Western world offering a tangible asset. It's not like the Magnificent Seven, which are offering a little bit of intangibles around cloud and tech and so on and so forth. So Costco's asset is not so much the warehouses, the stores. It is not so much the furniture that is inside the store, or neither the forklifts that help them maintain the supply chains or inventories in the warehouse, etc., etc. It's Costco's asset is an intangible difficult for others to replicate, right? Where they obviously understand what the customer wants, they reduce the SKUs, they increase the bulk buying, they create. The buyers are the moat, even in Costco, interestingly, just like I mentioned for Trent on Westside. So if the competitive edge is built not around a physical asset that others don't have access to, but if the competitive edge is built around an intangible asset that you have created, which others don't have access to, right? And those intangible assets could be something as simple as ability to manage compliance and logistics and build trust with the banks for a CMS, right? That's an intangible asset. You've built it via focus on accuracy in a highly regulated environment, where operational excellence for a regulated entity like a bank matters far more, and you build that trust. That trust is an asset, and if you can leverage on that trust, regardless of whether you offer a physical ATM or a service, your profit growth from such a business can be far faster than your fixed asset growth, right? So that's what I'm talking about. And the cycle also repeats. The reinvestment, if it is in more intangibles, you will see reinvestments, but those reinvestments will not build physical assets on the balance sheet. That's where the world is moving towards. That's where we are tilting our portfolio towards, because India is also headed in the same direction.
Right. And does this aspect of investment in intangibles play, or how does it play a role in position sizing?
So as I mentioned, wherever we see the jaw opening being accompanied by the jaw opening between profit growth and fixed assets, the jaw opening being accompanied by opportunities already put into motion to be capitalized in the years to come, we've got larger allocations there. So the tube trend, Narayana 3 examples that I gave you, They are not sitting on large cash piles waiting for an opportunity to drop at the table. They've kicked off the flywheel. Over the next 2-3 years, you'll see the benefits of those getting accrued. Wherever we then see the market is mispricing or underpricing some of this, right? So for instance, I don't think the degree to which Narayana is trying to capture the entire primary healthcare piece, creating a funnel, primary as in the OPD footfalls piece, not being in the hospital, but as a funnel closer to the house, and the integration of insurance, diagnostics, pharmacies, a model that has prevailed in the Western world in some shape or form, but massively kills the conflict of interest between insurance companies who might be rejecting a certain claim and the customer is not happy about it, or a doctor who might be overcharging for a therapy and the customer is not happy about it, or even the government, which doesn't find this whole piece of high pricing to be a very sustainable metric. All types of stakeholders get satisfied by what Narayana is building. Because they've kicked it off in motion, we've got a higher allocation to it. Position sizing is lower to situations where an Escorts is yet to build out its capacity expansion to make India the hub for global exports, where Dr. Lal is yet to choose a South India based asset that they are scouting for, after having turned around Suburban in the West for their next acquisition, whereas CMS is yet to fully figure out what to do with more than 10% of its market cap sitting as cash on the balance sheet, so on and so forth. So wherever we've got greater clarity, it is getting baked into our numbers. If it is not baked into the consensus or the broader stock market's appreciation of the price, that's where we are higher on position sizing.
Great. So I'll come back to certain aspects about reinvestment and cash flows, because let's first address I mean, if I may call it the elephant in the room, because lots of questions on Asian Paints. Number of questions are ranging from why are we not able to foresee the slowdown in Asian Paints, and downsize our position at an opportune time? Did our channel checks not pick up this slowdown? And what sort of an action have we taken? And what's the outlook going forward?
Right. So look, first of all, for Asian Paints, there is a macro contribution to the results that came out. Secondly, where we were disappointed was the gross margins being compressed in the second quarter, particularly when for many of their competitors, gross margin compression was not there. Could we have foreseen this? Well, first of all, the reasons for why Asian Paints' results in the second quarter are weaker than some of their competitors. There are three broad reasons. One is South India exposure for Asian Paints is significantly more, where rains and floods they obviously delay wherever you see rains and floods. There's going to be a delay in exterior paint projects particularly. And Asian Paints is significantly over-indexed to South India compared to some of the other listed players. Secondly, Asian Paints did resort to greater rebates to dealers, which led to some degree of margin compression. Now, could we have foreseen this? So, to be honest, our channel checks keep suggesting how Asian Paints is fighting the battle against Birla. We are reasonably clear on what Asian Paints is doing to empower some of the larger dealers with benefits, changing the architecture of the supply chain in a let's say tier 2 city or a tier 3 city to ensure that fortification of their market share happens. We are at the moment reasonably convinced that this is not going to be a structural drop in market share for Asian Paints. If there is a one quarter slower growth for reasons which are related to, such as say a South India rain or something, it's not so much competition. The competitive aspect is where we've been so far clear that there isn't enough reason to worry for Asian Paints, given the energy, the enterprise that the business is showing at the ground level. In terms of could we have foreseen the extent of gross margin compression, because that was actually the main disappointment vis-a-vis our expectations. To the extent that this gross margin compression, some of the factors are quite a one quarter phenomenon, and next quarter onwards things should be better. We are not significantly scaling down the position. We did scale down 2 years ago from 11% of the portfolio to a far lower number, which our clients would be aware of in Asian Paints. But at the same time, when you look at the consensus here, consensus is expecting 8 or 9% earnings growth from Asian Paints over the next 4 years, 5 years. We don't see the outcome being as bearish as that, and hence we are sticking our neck out and holding on to Asian Paints. This is not too dissimilar vis-a-vis some of the other challenges that we've had with some of our businesses in the portfolio in the past as well. So you might remember when, Dr. Lal Path Labs is a great example. It currently continues to be in our portfolio. All this Tata 1mg, Farm Easy, etc. They did wipe off maybe 1 or 2 quarters, few hundred basis points of growth rates for a Dr. Lal. But at the same time, the longer term structural moats, they come into play to protect, build market shares here, which is where we are reasonably convinced about Asian Paints. Having said that, never say never. There are companies in our portfolio in the past where we've woken up to challenges, either regulatory challenges or competitive challenges, or even management lethargy, slightly in the hindsight, and hence taken a corrective call on our position sizing. If we do see reasons for that in Asian Paints' case, we'll be more than happy to take a corrective action. But particularly the macro demand consumption slowdown that 2Q has reported. We had an inkling of some consumption slowdown across the board, but the degree was a big surprise to us. And this is not just for Asian Paints. This is not just for salt business or tea business of Tata Consumer. This is for the broader consumption market. Some of it couldn't be foreseen, and a lot of it we'll try to benefit from basis how the share price reacts and gives us opportunities to position size appropriately.
Yeah, fair enough. There is a related sort of pertinent question that Pramir Gandhi has asked. Are the storytelling and narratives around Asian Paints too simplistic, overlooking significant industry changes such as increased competitive intensity, dominance by large organized players, and heavy investment that is driving capacity growth far beyond demand? Will it not affect Asian Paints in the future?
Right. So first of all, increased competitive intensity. Certainly the amount of capital expenditure of Birla as a new competitor is far more pronounced than that of some of the older new competitors that have come into this industry. But having said that, large balance sheet players have kept coming here. And there is a reason why Asian Paints, Berger, these kinds of companies, they've managed to hold on to their fort and in fact get stronger out of these competitive battles. The reason is to begin with supply chain efficiencies, which if you go to the channel level, they matter a lot. right? ROIs for dealers are not through margins in this industry. They are only via inventory turns, and inventory turns are miles apart between an Asian at the top and including the new competitors, including Birla, some of the incumbents as well, so on and so forth. So that is the biggest part of the moat. It continues to be so. But then you can't just sit on one business model and expect it to deliver results forever. So the moat has to deepen and evolve, which is where with what Asian Paints has done to its product portfolio, what Asian Paints has done to the, as a result, long-term runway of growth going beyond paint as well. It adds a bit more muscle. There is no evidence yet. There is no evidence yet that Birla is taking away as much as 5 or 7% of the market share in a single quarter, and hence, had that not happened, Asian Paints' growth would have been 5% higher or 7% higher or something like that, right? So there isn't evidence of this. The way business gets done at a channel level, the way business gets done at a point of sale level, we are reasonably clear how competitive advantages matter to which businesses, and hence taking those calls. And again, I mean, if things were linear for all companies at all points of time, then the story would be certainly different. But here there are multiple factors at play when the quarterly results got announced, which is why we are holding on to our position here.
Great. Another stock that as always attracts more more questions is HDFC Bank. But here the questions are more in terms of why do we think that HDFC Bank will not outperform going forward, given upcoming rate cuts and margin compression, or the fact that obviously it's the cheapest private sector bank at the moment, but at any signs of weakness in the market, it still gets punished. How do we see that in terms of our position size in the portfolio, which is relatively on the higher side?
Right. So HDFC Bank has continued to gain market share throughout the last 4 or 5 years in both deposits as well as on the asset side, right? Where the share price took a massive beating was it was on the higher side on price to book multiples 3-4 years ago. The gap between HDFC Bank and the public sector banks, particularly in terms of NPAs, it narrowed down, which is largely a cyclical phenomenon. And there were regulatory changes, regulatory decisions that were put in place. Products were banned, and some of the other announcements, which led to a stagnation of the share price. When you look at the fundamentals, I mean, they're there on the screen in front of you. EPS growth, despite the dampening of 1 out of the 5 years through the HDFC Limited acquisition, where absorbing the asset itself led to 1 year EPS growth being 0, and continues to be pretty weak. Despite that, EPS growth here is a healthy 16%. Going forward, we expect it to be continuing to be in the higher teens. ROEs here again in the mid to higher teens. Market shares, we expect it to continue to be gained going forward. Now, in terms of the share price reaction, well, I think saying that low price to book should give a greater defense compared to high price to book. And I'm talking about, I'm interpreting the question that Arjun, you pointed, that today HDFC Bank's price to book is lower than what it was 3-4 years ago, though. So why is it not significantly resilient in the stock market fall? I mean, theoretically speaking, let me put it this way. When you're looking at 1 month share price reactions, which are too short term, even a CMS Info System with a 15 or 17 times price to book 1 year forward it has fallen by 20%, right, from where it was about a month ago. So low price to book, can it protect you on the downside over a 1 month time period or a 45-day time period? I think the answer is no. When there's panic in the market, when there's drawdown in the broader market, you might have irrationality at share price levels in the very short term. At the very least, it gives you opportunities to benefit from, right? So, which is what we'll always be taking up with both hands. We've done that in the past. So, for instance, what we did with the Bajaj Finance when it fell by 60%, 5 years ago or 4 years ago, what we did with Dr. Lal Path Labs, doubling down on it when it fell by 50, 60%. Those were opportunities. They will be more smaller or equally large opportunities going forward. I don't know if in this crash or not, but we'll be keeping our eyes open, and that's where I think the portfolio construction piece really comes into light. We have to benefit from these, stick to the fundamentals, keep clarity of thought in terms of what drives share price performance from the next 3 to 5 year perspective. Are we invested in companies where, and this applies to HDFC Bank relative to other banks, are we invested in companies where fundamental growth will be far stronger than those of other businesses? Are there areas where we can, as a result, then leverage on the disconnect between fundamentals and share prices if it emerges in the short term? That's what stock market crashes really offer you, which we are going to capitalize on.
Right. Similarly, another stock we've held on for a while, Bajaj Finance. Any thoughts on that?
So Bajaj Finance, we've trimmed the position size, trying to take a conservative view of how the NPA bottoming out of the unsecured loan cycle happens, and there are a couple of other factors as well, which we are very watchful of how they evolve, and hence we've taken sort of a brace position here. But again, I mean, these are interesting times, and we'll see if opportunities arise to scale up, to double down.
Fair enough. So there are several, stock level questions which I can come back to. Let's address a few questions which are more at the portfolio level now. So the current list of CCP stocks is 19, and earlier we always sort of reiterated the fact that we will limit the count to 15. What has changed in the last 2 years that has led Marcellus to increase the stock count to 19, and will that number now be sacrosanct?
Right. So we discussed this in our previous webinar. What we realized, I mean, there's a paradigm change. There's a paradigm change in the quality universe that we have understood. We understood it with a 12-month lag, I would say, compared to where we would have been comfortable understanding it. So COVID led to the quality universe definition evolving significantly, where companies only doing more of the same repeatedly over long periods of time previously used to be the ones generating the highest earnings growth, highest returns on capital employed, and hence were part of our coverage universe. That was a reasonably limited coverage universe pre-COVID. Through COVID, this paradigm shifted to companies very actively using their cash generation to go beyond the core, which we, as a result, hence called enterprising compounders, which made two types of changes to our coverage universe. One, the number of stocks that were doing more of the same in a repeated way, it actually reduced a bit, because some of them saw competitors coming in from other peripheral areas and and diluting the competitive edge of these incumbent high-quality businesses. At the same time, the high returns on capital employed, drivers of those became far more reinvestment rates oriented rather than only more of the same core capital reinvestment, which typically tends to be less than 50% for a typical established business. So businesses with 80% reinvestment rate, 20-25% return on capital employed became far more widely available, which weren't available as in as many in as large a population previously, where previously the larger population set was 50% return on capital employed and 50% reinvestment rate, or in fact 40% return on capital employed and 50% reinvestment rate. So the 40-50 combination shifted to 80-25 combination, 80% reinvestment rate and 25% or 30% return on capital employed, because of the energy enterprise shown by several well-established corporates, many of them being new entrants to the CCP portfolio. What that has done is it has widened the coverage universe significantly. We've gone beyond just 3 or 4 sectors. We've added, as I mentioned, we've added manufacturing, exports, auto anchs, some of the healthcare areas like hospitals that we didn't have exposure to previously. All of these, so no hospital was generating healthy ROCE pre-COVID, right? It's not that healthcare was not needed. It's just that the enterprises came through. Several of the new entrants as a result were very different companies till 5 years ago. Compared to the product portfolios 5 years ago, they are much wider. The competitive advantages 5 years ago, they are much wider, and hence evolution of the nature of quality as a definition led to us widening the coverage universe and bringing in newer exposures, which is where the 15 stock coverage and the 15 stock holding portfolio has become more like a 18 to 20. For the foreseeable future, it looks like the 18 to 20 is the band where we'll be comfortable with. If there is a need to go back to 15 in future again, we'll consider that. If there's a need to stick to 18 to 20 only, then we'll stick to that. But this is something which in far greater detail we had highlighted in our previous webinars, which you can watch.
Right. So one aspect of your answer was to do with reinvestment rates. So I'll just quickly cover a couple of questions here. Is there a threshold above which reinvestment is healthy? A threshold above which we consider reinvestment rates to be healthy, and that's where those kind of companies become part of our consideration?
So, I mean, the threshold is more on earnings growth, more on cash flow growth, operating cash flows and free cash flow. The moment you're choosing higher reinvestment rate, free cash flows are going to be very volatile, because the years in which you do large capex or large reinvestment decisions, you'll see free cash flows going down. So when you come to operating cash flows or earnings, if you stick to those two metrics, that's where the thresholds sit. We want at least say 18 to 20% sort of earnings growth, operating cash flow growth, ideally higher the better. Now, let's take a round number 20. A 20% earnings growth can either be delivered by 40% return on capital employed, half of which gets plowed back via reinvestment rate of 50%. Right? So 50 multiplied by 40 is 20. Simple maths. That becomes the engine for 20% reinvestment rate, 20% earnings growth. As long as that engine is not at risk of fatigue, lethargy, or intense competition, because you're effectively doing more of the same if you're reinvesting half or less than half of your cash flows, we might be comfortable with it, not otherwise. Usually, we are not comfortable with the risks that run around fatigue or around competitive intensity of of a company which is not going beyond their core. As a result, either you can get the 20% by 50 multiplied by 40, or else the bulk of the portfolio that you see here, which is 70-80% reinvestment rates, in some cases even 90% reinvestment rates. And obviously, when you reinvest in a new area, initially your return on capital employed in the new area is going to be significantly lower than your core business's return on capital employed. And over a period of time, it will ramp up with the jaw opening, right? The jaw opening of PAT growth being faster than fixed asset growth. The jaw opening will lead to, some part of the jaw opening will lead to return on capital employed increasing over a period of time. And then you again, on the high ROCE, you reinvest 80-90% back into a business with low ROCE, and you ramp up their ROCE, so on and so forth. So that flywheel has to continue. On average, cross cycle, such businesses would have a 70-90% reinvestment rate with a 25-30% return on capital employed, and hence a earnings growth of 20% plus. That's what we are after, really. That's in a way what you can see here, FY20 to 24, this portfolio's profit after tax compounding, median or weighted average mid-20s to high 20s, delivered via 80% reinvestment of 25% return on capital employed. So thresholds are more around growth numbers, but behind the growth numbers are reinvestment rates. What I in a way answered in the last 5 minutes is more mechanical. Behind the mechanics has to be an understanding of capital allocation discipline and competitive advantages, which is far more intangible ways to arrive at the answer that you're seeking.
Right. There's another question. Again, I'll take a portfolio level, question where Shrikant is asking, given the recent drawdowns being witnessed in the broader Indian stock market, what are the chances that some of the companies that used to be part of our portfolios for a long time, and we've exited those, but in this broader market correction, if the valuations appear attractive to what are the chances of these stocks coming back into the portfolio?
There are chances. I mean, they are all part of our coverage universe. If the concern because of which we exited from some of them, as I mentioned, was their reinvestment rates dropping down to 10% or 15%, and enterprise getting diluted in a way, the enterprising energy or enterprising streak towards these companies getting diluted. If that was the concern, then we need to first see firing up of their engines around enterprising decision making. If we don't see that, then just because those businesses are available at cheap valuation doesn't really mean we'll be too keen to buy them. We don't want to compromise on quality. That is something we are very, very clear. So if that is the answer, that something that used to be quality is not quality anymore, that falls significantly, will you consider it? The answer to that is a clear no. If there is something that was quality, we exited from it for reasons other than the business not being quality anymore, because we had a better substitute, or because we could see that what is being priced in versus what the business is going to be delivered has a big disconnect. Then those kinds of opportunities, if they are available at cheaper prices significantly, then yes, we will be certainly willing to reconsider. And they are all part of our coverage. So at the moment, the coverage universe, in fact, for entire Marcellus research team is roughly twice as much as what it used to be till 2 years ago.
Fair enough. Questions related to a couple of stocks that you mentioned while discussing the thematic. So first one is Narayana. The question is, do you think insurance initiative of Narayana will have a market outside of customers of their hospitals? So essentially, the question is,
got it.
The insurance product, will they have a wider market? Yeah.
Yeah. So, I mean, that's not part of our hypothesis. I hope they are able to scale up the insurance piece without being a completely open insurance company, but more limited to limited to their patients needing treatment in an emergency outside of the Narayana network, or limiting their insurance offerings to their patients needing any kind of treatments and healthcare within the Narayana ecosystem. So it's that is what we currently understand is the opportunity here as investors in this business, and we'll keep watching it. The insurance piece for Narayana in the hypothesis is actually the furthest out into the future. I mean, it's not part of our next 4-5 years of forecasts. Honestly speaking, on Narayana, that's an optionality like the home decor services of Asian Paints. It's an optionality which might play out after the next 5 years in a meaningful way to move the needle for the broader business. So for Narayana, the greater optionalities here are first and foremost squeezing of the lemon in the next couple of years, where on their existing bed capacities, through the tech interventions that they have done so successfully in the last 4, 5, 6 years, gradually first in Cayman, then in Bangalore's Health City, and then they are yet to be taken in a meaningful way to Kolkata, and from Bangalore Health City to other parts of the southern cluster that they have. And there are improvements which even a Bangalore is yet to fully implement. So, for instance, their Namaha platform for the paramedics to enter the various types of details, which currently the traditional way going forward will be replaced by the digital way, so on and so forth. Even a Bangalore is yet to fully benefit from that. It's happening this year, literally. So that's the first piece of optionality, squeezing of the lemon. The second piece is building up capacities within their existing clusters, which is something that will start firing up 2 years out. And thereafter comes the bigger piece of the integrated clinics, by then hopefully becoming large enough to start moving the needle beyond the next 4, 5 years. Once the integrated clinic scales up as a construct, only then can we expect the insurance piece to also scale up in a meaningful manner. Because if you haven't been tracking the entire health journey of a patient, then offering insurance policies to all and sundry can always lead to adverse selection. Adverse selection is going to be a massive risk. People who really need to make claims will take up the insurance proposition, and that adverse selection can backfire massively without scale. Because if you don't build out the insurance proposition at scale across all sorts of geographies and all sorts of customer demographics, then without scale, running an insurance firm is always going to lead to adverse selection risks, which will burn holes in the balance sheets of any business. So I think for the conflict of interest getting taken away being the heart of some of these initiatives of integrated clinics and the insurance business, you need first these platforms to be built. First, the tech platform to be fully squeezing out efficiencies in the current construct, then the bed capacities to get scaled up for the funnel to really give patients incrementally in a more meaningful manner. Once the bed capacities have been scaled up, then the funnel becoming big enough to move the needle. And once the needle starts moving in a big way via the funnel, the insurance piece kicking in becomes the icing on the cake. So that's how we see the build out. We'll see if the build out is as per expectations to make healthy returns out of investment in Narayana, which is something which will be our ongoing research process if it's going on well or not.
Another question with in relation to one of the stocks you mentioned while discussing the thematic is CMS, and the question is why, how does it fit into the CCP universe, given the business model is ATM fulfillment, Though cash is at a high in the system, there has been a decline in bank ATMs, and UPI is being widely used. There's a possibility that it may lead to lesser footfalls at ATMs. Is it a sustainable business model?
Yeah, so first and foremost, when you look at the history, why does it fit into CCP coverage? On simple metrics, you can see why it makes sense. For a very long period of time, consistently compounding revenues and earnings at a healthy pace, 15% plus, more like a 20% plus on earnings, and returns on capital employed in the mid 20s pretty consistently. So that's where it enters into the universe. It's a large dominant player, a near monopoly in the kind of services that it offers to the customers that it has so far been catering to, right? So that's there. Now, coming to your question on the TAM being limited. So first and foremost, the investment case here is not just ATMs and cash management. That part is not going to grow at a very healthy pace. At best, 10, 11, 12%. Why even 10, 11, 12? Why not zero is an embedded question in what you're asking, Arjun, what somebody is asking us. So why 10, 11 to begin with in cash management? Why not zero? Roughly half of the ATMs out there are yet to be outsourced by the banks. They are being managed. The cash management services are in-house. As time is progressing, more and more efficiency benefits are coming through via outsourcing. So in a way, the penetration of third-party ATM management into the broader ATM pie is nowhere close to saturation. It's only about 50% done, give or take, plus minus 5%. And hence that's one runway for growth. Within the 50% that have been outsourced, there's a market share gain by locking in one customer and scaling them up across geographies, which which CMS has been successfully doing, will continue to do. So that's the reason why over the next, say, 4-5 years, we don't see the cash management piece being zero. At the same time, you're very right in saying, the person asking the question, very right in saying that this will not give us a 20% earnings CAGR by itself, right? Which is where the third part shown on the screen in front of you, the synergies piece, kicks in. Growth for CMS is not coming through ATM cash generation. ATM cash generation brings a broad foundation on which the rest of the business is being built. It's cross-sell and upsell of other capabilities to the bank, not just related to ATMs, right? So to begin with, even within the ATMs, there are many things beyond cash management that they're doing. So for instance, replacing the security guard sitting outside the ATM with AIoT, which they've managed to grow pretty rapidly. It's quite remarkable how the economics are favorable for the owner of the ATM, in this case the bank, to do that part of outsourcing, and the outcomes are effective. So that's one example of within the ATM, how can you sweat the relationship harder. But then there's massive route efficiency benefits as well. So if you're carrying cash from one bank to an ATM, on the way there's a Westside or a Zudio from where you can also pick up the cash and take it to the nearby bank branch. Because Westside or Zudio might have an account with your banking client, and the bank asks you to, on the way, pick up cash from a Westside as well. I'm taking as an example. Then that is route efficiencies and plugging in more services within the same route of cash in transit vans that they've got operated. All of this effectively joint at the hip around locking in the customer via trust of compliance, logistics, tech, some hardware solutions, and other various types of other services. This is what CMS has built. In the foreseeable future, we don't see it stalling because of the cash not going up in the system. By the way, the cash hasn't gone down in the system either. So if cash utilization every year was dropping by 15-20%, it would be a different matter altogether. Here, cash utilization is stagnant, and we expect it to remain largely stagnant in the economy, even if it goes down by 1, 2, 3%. That's not a meaningful needle mover compared to the growth drivers of CMS, which are way beyond just ATM cash management of their existing ATMs.
In fact, cash in the system has doubled since demonetization, which is pretty much in line with inflation rate, right? So
yeah, I'm taking the conservative view and still building up the investment hypothesis. What Arjun is saying is the conservative view has upside to it.
Right. So moving on, another question related to the reinvestment rate and partly related to the thematic. So it's on Tata Consumer. The reinvestment rate is at the relatively at the lower end of the range. In the portfolio, and ROC is single digit. So what gives us the confidence that the current reinvestment rate will bump up the ROC going forward?
Yeah, so historical ROC is in single digits because a lot of the reinvestment went into acquisitions, which were good products, not scaled up into distribution channels by the erstwhile promoters of those acquired entities. And as a Ching's noodle, as a soulful, as a brand, as various other acquired assets of Tata Consumer, they are put through a product development engine of using the same brand to widen the portfolio. Let's say what they've done with Organic India ever since they've acquired it, and then pumping it into the roughly 4.5 million outlets of distribution channel that they have so far created in salt and teas and various other categories. That's where on the acquired entity, because you are acquiring an asset more for the goodwill of the brand, the profits entirely haven't yet come through. The return on capital employed initially drops, but then on all of their acquired assets, when you look at what they've managed to deliver over the next 2-3 years through integration efficiencies, it's phenomenal. I mean, the ROIs on some of their acquired assets are 80-90% annualized in the last 4 years. And they made a couple of recent large acquisitions in January, because of which the recent returns on capital employed have been more muted. Average for the last 4 years ROC is 9%, but it's on an uprise. When you look at the point-to-point movement of that average 9%, it's from lower levels to higher levels. And going forward, we expect it to be a significantly higher return on capital employed.
Right. So there's one question on Titan. Shrikant is asking whether we have an update on our concerns around lab-grown diamonds, which obviously had a part to play in our position sizing for the stock. Are we still waiting for this trend to play out? What's our view on that?
Yeah, it's quite interesting. This piece is evolving quarter after quarter in an interesting manner. Till 3 or 4 months ago, we could see a glut in Gujarat of manufacturers of lab-grown diamond. More supply than demand, and hence the glut indicating that LGD globally is not picking up in a very meaningful way. But at the same time, then data points come of Trent launching lab-grown diamonds, which is quite interesting. I mean, they might be doing it as an accessory from Westside. We'll see as they scale it up. It's available only in 9 Westside stores at the moment. The nearest one is in Borivali for those of you who are in Mumbai. So Trent entering into lab-grown diamonds, does it put a stamp of legitimacy on the whole concept or not? We'll see. Even Titan in the last quarter reporting that for the larger caratage above 1 carat, There were concerns from the recent customer purchases reflected, concerns reflected in the recent customer purchases around natural diamond prices for more than 1 carat going down, largely because of lab-grown diamonds and a few other factors at a global level, and hence is the store of value of natural diamonds, larger caratage, still in place. As question marks on those thoughts are put, there's some moderation in the growth rate of that piece of the business. So it's an evolving space. We'll see. I mean, interestingly, even Titan hasn't said no to this entirely. We understand that they've done a lot of work in this space in the last 5 years. Let's see if they also make any move or not at all. And does the consumption mindset towards lab grown become any bigger in any meaningful way, which has implications on Titan, positive or negative. We'll keep assessing it. But yeah, I mean, we did take a conservative view 6-8 months ago. I mean, so far that position sizing call has played out. Not all such calls will play out. This one has played out near perfectly so far, and we'll see how we can keep playing that going forward.
Right. Thanks for that, Rashid. And so we are almost out of time, but if we could end this webinar with just say a broader level commentary or your view on what we've seen since the beginning of October, a broader market correction. Several macro indicators have been weak, leading to weak earnings growth, and in some areas the macro indicators are a bit of a mixed bag. There's no sort of conclusive trend there that they are currently projecting. So in that overall context, and because a lot of these macro aspects have impacted the performance of our portfolio companies as well. What's your broader view? How do you view this? Do you see this as a temporary phenomenon? Or it's and the fact that it may be transitory and things will come back. Broadly, how are you reading this?
So there are many moving parts to it to begin with, and hence it's not a disaster situation painted all across all parts of the economy. Let me put it that way. Consumption certainly under the pump. But at the same time, as I said, let's say if you compare this with what was happening 10 years ago, 2011 to 13, where consumption was still all right, but corporate balance sheets and bank balance sheets were under the pump. This time it's slightly the other way around. Corporate balance sheets, bank balance sheets are pretty healthy. Consumption is under the pump. So there are elements of strengths as well as weaknesses in the broader environment that we'll have to certainly bear in mind to the extent that some of those elements might be not just a 1 quarter phenomenon, and hence offer opportunities on both sides, on position sizing up as well as down, to benefit from that in the portfolio. Our aim and agenda, in effect, through this and every other such difficulty in the external environment will be, first and foremost, the bottom 2 rows of the table here. As this table keeps evolving, the bottom 2 rows have to remain healthy, both in absolute as well as relative terms, as in the earnings growth engine of our portfolio has to keep firing, both in absolute as well as relative terms. There will always be a couple of stocks reporting negative profits at, I mean, a Molnupiravir for a disease might happen, a Page Industries or a Dr. Lal Path Labs equivalent profit declines might happen off and on. But first and foremost, for the portfolio on the whole, we want to see healthy earnings growth being delivered via the position sizing and stock selection that we do here. The second piece is learning from areas of improvement in portfolio construction that in hindsight we could have brought in 2022. We have to bring those learnings actively at all points of time which we are doing. So as long as we stick to this kind of a discipline, that keep gunning for healthy fundamentals in absolute and relative way, and keep learning and improving from opportunities missed or mistakes made in the past. I think we'll be not just all right. We'll be compounding consistently and sticking to the philosophy, delivering a healthy rate of CAGR. So the 17% there or thereabouts that we have delivered since inception, net of fees and expenses, it's I would say a very marginally lower than what I would have been happy with, but it's still a satisfactory outcome. It has had several areas of missed opportunities in the last 6 years. Going forward, we'll try to deal with the weak external environment in a better way than we did previously. But thereafter, as long as our portfolio companies, they keep delivering a 20% plus earnings compounding, getting to a high teens portfolio performance CAGR should be doable for this portfolio, and that's what our aspiration, our objective of portfolio construction here is. So I don't know if in the next 1 month the stock market will go up or down, or by how much up or how much down. Very, very difficult, near impossible to figure that out. I don't know if our portfolio performance will be less resilient or more resilient than what it has been in the recent past. The very short-term calls are very difficult to make. So if the question comes, how do we see the next 2 months, 3 months play out? Very, very difficult to answer. But the moment you ask us about slightly longer time horizons for the next, say, 2, 4, 6 years, how do we see earnings pan out, competitive intensities emerge, opportunities come across, and capital allocation decisions being made? That's where we are very convinced, very comfortable with what we've got in the portfolio. We don't see too many areas of concern. We don't see the current macro not giving us opportunities for capitalization on the portfolio front going forward. So let's end at that, this webinar, and we'll keep updating you on how we are going on this objective of consistent compounding going forward.
Great. Thanks for that, Rakshit. And thank you to all the participants for joining in today. So for those who asked us questions and we were unable to answer those, be assured that we'll definitely revert to you. And for anything else, any other queries related to the portfolio or otherwise, feel free to drop us an email at invest@marcellus.in. And we'll take up your query and revert to you. Thank you so much. Have a good evening. Bye-bye.
Thanks, Arjun. Bye.